NBFCs. So that has been, of course, the talk of town. JM Financial Products and IIFL Finance, these are the two entities in question where we saw the RBI come out with some very, very stringent measures. So what does this tell us, and what is perhaps the road ahead looking like? Is this a sector-specific phenomena? Is it an entity-specific phenomena? How should the market read this? We have with us Abizer Diwanji, partner and national leader of financial services at EY India, and former RBI Deputy Governor SS Mundra. He'll be joining us in the next couple of minutes as well. Abizer, great to have you on the show. Thanks for joining in. What have you made of all the headlines and the noise over the last 48 hours or so? Because what we've seen is the RBI pretty much sharpening its stance and stopping companies in their tracks, literally, whether it was the gold financing business in the case of IIFL or loan against shares in the case of JM Financial. Your thoughts?
Yeah, firstly, it's not a 24-hour thing. I think it's been happening for a while. IIFL happened, over the last week. JM happened in the last 2-3 days. We've been seeing what's happening with Paytm on the KYC side. I think one is the larger concern that RBI seems to have, and I say this seems to have because clearly I'm not privy to the real facts, but from what it appears from the outside, is that I think there is a concern around the systemic risk build-out that's happening on the retail side. And I think more than justified in terms of the way people are being given loans or forced into loans. Some of those land up into consumerism, and hence repayment could be an issue once we have an income issue. So really, RBI seems to have realized that what is a loan? It's just discounting of future income, and if the future income seems a little uncertain, and which may be on the large part of the retail. Then in the quest for growth, should people be allowed to give credit, which will ultimately form systemic risk? And I think that is at the core of any of these actions that you see, whether it's KYC and multiple Paytm accounts being opened on the Paytm side, or whether it is issues around valuation of collateral for IIFL, or whether it's loan against shares being offered to people, significantly leveraging an equity market product that JM was offering. I think those are the issues. It's a larger concern, and RBI wants to make sure that the process stacks up and we don't have a larger systemic issue. That seems to be the basic concern. How justified it is, frankly, will be more towards the specific of every case.
Absolutely. Abizer, hi, good morning. From a capital market, equity market point of view, right? So in terms of interpretation, Mr. Mundra is also with us. So let me actually welcome in Mr. Mundra and sort of get him into the discussion as well. Mr. Mundra, from an equity market point of view, many are seeing what we've seen from the RBI, action and sort of messaging to a couple of NBFCs to mean that the RBI wants to cool capital market funding in that sense, right? I mean, things are getting a little too hot. Would you go that far and say, well, that is what they're trying to do? And then there are others who are saying, well, SEBI, the equity market regulator, also kind of in a letter to Mutual Funds Association, AMFI, said that there is some froth building in mid and small caps, right? That coming from the regulator is quite startling. So is there a kind of, would you say, and since you've kind of, you would know how this works, is there an attempt by regulators together to cool and the very hot equity markets? What's your sense, sir?
Is it a question to Abizer or to me?
To you, sir, Mr. Mundra.
Okay. No. I think what an interesting kind of correlation you have brought out, which I think, frankly, I would not even think about it.
No, it's not my correlation. It was just, I wanted to put that to you because many are, there's actually an opinion piece out there which kind of makes that correlation that maybe, there is exchange of information and they're trying to, because, now equity markets are so large, they're an important piece of what we call financial stability, right?
So let me give you my perception. Number one, to begin with, I don't think that there is any such thing like this, that both the regulators are talking about the equity market. And see, we are talking about one particular sector in large BFSI space. Within that sector, couple of entities, and that is a way to cool down the market. That's not the way, and that is not how the RBI works. I think as Abizer was also mentioning just some time back, and if you go back and look at some of the macro data, there is enough hint in FSR, financial stability report of RBI also. I think those are all the concerns because globally, what they call is NBFI sector, that is the non-banking financial intermediary. NBFC is a very typical Indian term. So globally, Financial Stability Board, which is the G20 body, had also been concerned about the share of NBFI in the overall, the financial sector. But within that, the NBFC, the lending entities, I think India is one of the highest share, having maybe something like US, UK, and India. The second thing, the last year, the FSR report, if you look at it, September 23, the credit growth in NBFC had been something like 21%, which was around 11% in the immediate preceding year. More importantly, personal loan in NBFCs in last 4 years have, increased at a CAGR of almost 33%, whereas the credit growth in the system had been 15%. So I think for any regulator, then within personal loan, the components, concentration of risk in any particular sector. So I think for any regulator, these are some of the macro indicators which prompt the policy action. So that is on the policy action or on the macro side. When you come to the micro side, individual entity, then of course there is an inspection, there is a regulation with the company. And you must have seen, nothing has happened overnight or nothing has happened in a month. I think there had been engaged in dialogue, there had been inspections, the opportunity has been given to correct. This is from where I think all it comes.
Sure. Mr. Mundra, sir, good morning. If I could just ask you a follow-up question. I think...
let me wish you a happy Women's Day. Then we come to the question.
Thank you so much. Really, really appreciate it. And I'll extend that wish to all of us, all the women here at CNBC-TV18, and of course, all our viewers as well. But sir, just to come back to the point, I think the RBI's intentions have never been doubted. They're out there to put the guardrails in. And we've seen that happen, right? When the risk weights went up, that was the first step on unsecured lending. And now what we're seeing in specific NBFC segments. I think a question that was also doing the rounds yesterday, that while RBI slams the brakes, and in some cases it has been absolutely immediate, from the very next day, because financial markets are interlinked, could it lead to any kind of other accidents? I don't want to go back and compare this to 2018 and what happened with NBFCs then. But for instance, yesterday, one of the entities where there's been RBI action, one of the investors had to come in and say that we're putting up $200 million as a line of liquidity, just to ensure that there's no breakdown in market confidence. What about the collateral damage and the ramifications of what is perhaps much needed RBI action?
See, as I just mentioned, you said that, okay, they issued the directive today and it is applicable from tomorrow. But what I have been trying to tell you, and I just mentioned, that this would have been something which was in making for quite some time. If you, I won't name any individual entity, but you take the first instance where RBI took action a month back. And if you look at the history, it was somewhere in March 22 that the first action was taken. That, okay, don't onboard the new customer. And now we are talking about almost 2 years from that date till now. And there must have been dialogue, there must have been report, there must have been follow-up inspection. I'm sure it must have been the similar cases in other things also. So, number one, what I'm trying to say, no action by the regulator, RBI, at least I can tell you with little bit of let's say, confidence of insight. There is nothing like abrupt action. There is nothing like ad hoc action. Enough dialogues happen. And I think in whole scheme of things, as I said, a large financial sector, within that a particular sector, within that couple of entities, and even within that entities, couple of their portfolio. By no stretch of imagination, I would think that it can lead to a systemic risk or a collateral damage or a kind of, turmoil in the market. Yeah, there could be impact on individual entities, but then yes, if it has been making for such a long time, I think it was required to gear up. Though there are difficulties in doing that also. If we have time, maybe I would comment on that.
Right, we take that. And, what you've said, I'll just paraphrase what the RBI governor said in the last monetary policy meeting as well. And this was with regards to the questions around Paytm, where they said that it was supervisory action for persistent non-compliance, and they had been engaging with the entity for a very long time. And the RBI does give sufficient time for entities to comply, and at times even more than sufficient. So those points are well taken. Abizer, from a company standpoint, what is it that they should be doing to perhaps, not run into this regulatory risk? Because there's this constant tug of war where the market wants growth, the kind of valuations that these companies are trading at, the kind of funds that are chasing these companies at the valuations that they're trading at. They're tempted to do something which may hurt, the regulatory things here. So how does one navigate through this tug of war? What is it that people like you can advise to them?
So there lies the problem, as you rightly said, that, it's the question of growth getting stifled a bit. And that's exactly possibly where the regulator is saying, halt, take a pause and figure out what you're doing to whom. And frankly, a lot of the stock price drops that you're talking about are happening not because there's a liquidity crunch. It's great for somebody to come and reinforce that, there is liquidity available. But there is not a liquidity problem. The problem is that of growth. And frankly, what an RBI or any other regulator would want to say, let's not have unabashed growth, where customers are getting lured into risks that they are not aware of. And there is a consequential impact of that on the systemic risk. So if you put that into perspective, I think, should growth be paused in some cases? Yes. Now, what's happening on the banking sector, or the financial services sector? Banks are also trying to chase growth. Banks have an inherent advantage of their cost of deposits. They are trying to go and pitch products which were hereto NBFCs domains. NBFCs are pushing themselves further down that track, either into more ignorant customers or compromising on collaterals and getting their own growth done in a particular fashion. Now, what is happening in this whole thing is India is getting more and more consumer debt laden, and that itself could cause a systemic risk. And what the RBI is trying to say is that while it may not kind of collapse the financial system, let's make sure that there is enough safeguards being put in so that the right kind of credit gets offered. I think that is what the growth will get stifled. I also think, frankly, a similar action will now be taken by the banks themselves to make sure that their own KYC processes are better. Every other NBFC which has not been targeted until now is actually relooking at their processes anyway. So in a way, making these things exemplary, others are also trying to cut down. So while the stocks of these two companies may be going down, I think others should go down too, because growth will get stifled across.
The signaling impact is quite powerful as well, right? But a great conversation with both of you, Mr. Mundra and Abizer. Appreciate you joining us here on the program. I've said this before, the regulators, of course, have much more data than you and I and generally all of us have. And they've been extremely proactive. And, I remember the RBI governor a couple of months back, this was late last year, he said financial stability is a public good. And we've kind of fought hard for it, and we will protect it at any cost. And I think perhaps a lot of this individual kind of instances should be seen in that light as well. The market's, by the way, absolutely flat, 2-point change or so. We'll take a quick commercial break here.